Spandana Sphoorty, a non-bank micro-lender, has seen a sharp rise of around 17% in the last 1 month. Now, the rally in the stock price isn't surprising given the strong rebound in the collection efficiency. In our Ideas for Profit today, we'll discuss how this micro-lender seems set for a re-rating with improving macros. Now, Spandana's monthly collection efficiency had actually plunged to 2.9% back in April 2020 following the nationwide lockdown. However, with the relaxations in the lockdown, the monthly collection efficiency also improved to 101.8% in the month of September. Now, collections so far have been quite resilient, and that is despite the relatively weaker credit profiles of the micro borrowers, and the bounce back has been much faster than expected. Now, Spandana's assets under management have also increased to over 7,300 crore rupees as of September, which is an increase of about 36% on a year-on-year basis, and that's driven by the strong disbursements. Now, while the disbursements had been negligible at about 49 crore rupees in Q1 of FY21, it has jumped to an all-time high of monthly disbursements of around 900 crore rupees in September. Now, the management also expects the assets under management to increase to about 9,000 crore rupees by March end of 2021. And now, if achieved, this will be around 25 to 30% of year-on-year growth in the assets under management as well. Now, Spandana's plan to grow its asset book is well supported with the capital adequacy ratio, which is well above the regulatory requirement of 15%. Now, Spandana also holds the cash and cash equivalents of about 462 crore rupees and the unutilized bank lines of about 450 crore rupees. Now, both of these could cover 2 months of the repayment, assuming even nil inflows. Now, historically speaking, Spandana has actually significantly relied on the securitization, also assignments, to meet its funding needs. Now, despite being on an upward trajectory, we've seen that the collection efficiency, that is excluding the overdues, was significantly lower at around 93%. And there is still some way to go up before reaching the pre-pandemic collection levels of, say, 98 to 99%. Now, to meet the future contingencies, Spandana has also created additional provisions amounting to, say, about 332 crore rupees, and that is till end of September. Now, these upfront provisions are an equivalent to, say, 6% of its balance sheet loan portfolio. Now, while the front-loading credit cost is definitely heartening, the moot question over here remains, is it sufficient? Well, the management definitely believes that it is sufficient to meet at least the COVID-19 related stress. That said, the investors should recall that the credit losses seen by the overall microfinance industry, that is during demonetization, were much higher and reached between, say, 3 to 13%. Also, when you see Spandana's asset quality is highly vulnerable given the unsecured nature of the microfinance loans. Also, in addition, Spandana has a unique concern currently, that is relating to the stability in the second line of management. If you remember, the company has seen some churn in the senior management team, with the CFO resigning, also the chief risk officer and the company secretary. They all resigned almost simultaneously in FY19 and FY20. Now, the operations or the day-to-day operations of the company are really dependent on Padmaja Reddy, the promoter and managing director of the company, who holds about a 16% stake in the company currently. Now, the company is taking initiatives to augment its senior management team. They are hiring on the high levels as well. Now, Spandana's profitability in the last couple of years has been quite healthy, with return on assets, say, about 5% or over of that as well. However, the high provisions have definitely marred the profitability, at least this fiscal year. Now, at Moneycontrol Research, we expect the company's profitability to revert to healthy levels in FY22. Now, at the current market price, when you talk about valuations, Spandana is trading at, say, 1.4 times the estimated book value of FY22, which is reasonable enough given the strong returns profile, or ROA of 5% and the ROE of 15%. And on a relative basis, when you compare the valuations, they look compelling when you compare it to the peer Credit Access Grameen, which is currently trading at about 2.5 times FY22 estimated book value. Now, the valuation gap can definitely narrow in the near to medium term, and Spandana can re-rate. Now, while Credit Access Grameen is the safer bet in the microfinance space, Spandana definitely offers higher upside to investors right now. So, investors with high risk appetite and an ability to shoulder the inherent risk associated with microfinance business can definitely look at buying this stock currently.